Hi, my name is Jay and I make finance videos. So the purpose of today's video is going to be talking about variable versus fixed interest rates, and specifically talking about mortgage rates and sort of breaking down in what they both mean and which situations might be beneficial for you. So when looking at a mortgage, you have a lifetime for that mortgage. And so that might be something like 20, 25 years. And that's the amount of time that it will take you to pay off that mortgage. Now, within that mortgage, there are a number of smaller segments called terms. And these terms are sort of periods of time where you negotiate an interest rate with your mortgage company or bank. And these individual terms will make up that full mortgage. And so typically you'll see a term is going to be 5 years or less. And so in the example of having a 25-year mortgage, if you have 5-year terms, you're going to have 5 periods of time where you have an sort of an interest rate negotiated for that period, and each time the term expires or comes due, you have to go back to the bank and negotiate a new interest rate for that mortgage. And each time you do negotiate a term, you have the option of choosing a variable or a fixed rate. So what are they? Well, a fixed rate is pretty straightforward. You go into the bank and say, well, interest rates are currently 4%. I want to lock in an interest rate for that term. And so if you have a 5-year term, you want to lock it in, they'll say, okay, that's great. What we'll do is we'll offer you 4.4% for that period of time. And so you know 100% that over that 5-year term, your interest rate is going to be 4.4%. It's locked in. It's predictable and it's set. A variable interest rate is when your mortgage rate for that term is tied to market rates. So when you get that variable rate, it's 4%. Well, if the market rates rose up to 8%, well, your variable rate is going to rise as well. If they fall to 3%, variable rate is going to fall. So effectively what it means is that your rate for your mortgage is tied to the markets, and changes in the markets will change your variable rate as well. So what are the advantages and disadvantages of both? Well, obviously with fixed, the biggest advantage is it's predictable. You know exactly how much you're going to pay over that term. It is a locked-in fixed amount, very stable and secure in that sense. The drawback is the bank will charge you more money for it. The reason being, because there's extra safety, because it's more secure for you, they're going to charge you a premium for that in your interest rate. So they're going to charge you more interest overall for that security. Variable rates, one of the benefits is that you're not going to have to pay for that premium that you see on fixed. So you're going to see an overall lower interest rate initially. But the problem is that you do have that variability. You do have that risk and volatility of the potential for your interest rates to rise and fall. There's no predictability. If interest rates skyrocket, your variable rate will skyrocket as well. And your mortgage payments will skyrocket as well. And that can be very dangerous. So what are the situations you should get a fixed or a variable? If you are a very risk-adverse individual, meaning that you don't deal well with risk, you don't deal well with unpredictability, 100% you should be going with fixed. Fixed is more secure and it's better if you don't deal well with risk. Variable, it is a good option if you're someone who is comfortable with risk, who can deal with sort of unpredictability, and because you do get the advantage of a slightly lower interest rate, but again, you still have to understand that when you do go with a variable, there is more risk involved because you can see your mortgage payments change significantly during that period. So if you do decide to go with a variable mortgage, if you are someone who is more comfortable with risk and decides to take advantage of that slightly lower interest rate, it's really important that you have money set aside in either an emergency fund or savings accounts to cover any shortfalls that might have happened. So if you do decide to go with a variable rate and it starts at 4% and it rises to 11%, it's important that you have money in savings to cover the increase as you'll see in your mortgage payments. And so that's sort of the two main options. It is also very important to understand though, even with a fixed rate mortgage where you have sort of a locked in interest rate for that period, every time your term comes due, every time you have to go back and negotiate with the bank, well, you're going to have to negotiate with the market rates. So in that previous example where you had that 4.4% locked in, well, once your term expires, and if interest rates are still 11%, you're going to have to go back to the bank and you're going to have to renegotiate your interest rates. And a fixed interest rate at that point would be something like 11.8%. So even though you have more security with a fixed rate, it's really important to understand that in both situations, realistically, you need some form of savings, some form of emergency fund, and some form of plan to deal with rises in interest rate, to cover increases. You're protected for that 5 years with that fixed rate term, but after that 5 years comes up, you can still be burned by high interest rates. So that's sort of the breakdown of the difference between variable and fixed. Variable meaning slightly less interest, more risk, fixed, less risk, a little bit more expensive. Hopefully that sort of helped break down those two, or sort of this concept. As always, if you like the video, very much appreciate a like, share, and subscribe. It helps me and the channel grow. And as always, have a great day.